Welcome, everybody. Let's go ahead and get started. So, as I mentioned, this webinar is going to be recorded to present to anybody who missed it. We will also go ahead and make it available to the general public on our YouTube channel, which I'll get to in a hot second. But for anybody who is watching the recording and is not a client, you might be wondering who Jared Rogers is. I'm the president and CEO of Wilson Rogers & Company. We're a Chicago-based financial services firm. I am a year-round tax advisor, and I'm a CPA licensed here in the state of Illinois. I am been married for 14 years. You see the nice, lovely little picture of my family to the right. And I have one lovely daughter who is 11, going on 30. I am also the author of the two books that you see, How to Slash Your Taxes Legally and Ethically, and the Real Estate Broker's Little Black Tax Book. With regards to services that we offer, we specialize in complex areas of taxation and tax debt resolution. So that is, do you owe $10,000 or more to the IRS? Then call us now. So that is one of the services that we have, specialized for real estate, landlords, brokers, realtors, contractors, specializing in service-based businesses, consultants, financial service providers, dentists, attorneys, etc. From a legal standpoint or org structure standpoint, those that are S-corps or multi-member LLCs, because we're familiar with the taxation as well as the penalties that they incur for not filing on time. We also help people who have old taxes get caught up, and I represent people before the IRS and the state, solving tax debt that cannot be fully paid within a single payment. All right, with all of that out of the way, before we get into the meat and potatoes of the presentation, I just wanted to ask you, have you seen our YouTube video series? So we have two now. The first one is Minding My Money Mondays, which is personal money management. Goes over budgeting, saving, investing, smart spending, and a new video is released every Monday. And then there is Tax Chit Chat, which we just started this past week. It is a tax spin-off, so it is specific to tax questions. And it also will have routine content, but we have not yet determined the schedule for that. If you go out to this right here, it is YouTube C Wilson Rogers & Company. You'll be taken to our channel, and you can see all of the craziness that we've got going on with regards to videos right now. So this one right here was the most recent episode. Yes, that's Cuba Gooding Jr. from Show Me the Money and Jerry Maguire. And this is 3 reasons people are broke. But this is the first Tax Chit Chat. So after each video, you can see if it's Minding My Money Mondays or if it's Tax Chit Chat. So this one is going over 5 2020 year-end tax tips. That's what we give to the public, but you're going to get much more, all right? And so you can feel free to go out and look at these after you get finished on our website. So if you head over to wilsonrogers.net, under our blog, all the blog posts get posted from most recent to the previous ones. We just put out there the Money Management YouTube series. This gives a little bit of the reason why this channel was even started. Yes, it did have something to do with George Floyd and his impact and his inspiration and legacy. And we also give you all of the listing on all the videos. So you could easily just click on a video and it's going to take you into YouTube itself. If you watch a YouTube video and you have a question, you can send it to questions@makemymoneymakesense.com. That's a money management website that will luckily be launched in H2 of next year. And then once again, youtube.com/C Wilson Rogers Company Inc. is the channel. All right, fun stuff out the way. Things that you all need to remember or be mindful of for 2020, some of which are new, some of which are just reminders. Anybody who got or was entitled to an economic impact payment, AKA a stimulus payment, there is a line on the tax return in which you will potentially reconcile or claim the recovery rebate credit, which basically means you didn't get the stimulus payment before the end of the year. You might be able to claim a credit for it on the actual tax return. So once again, you can claim the credit if eligible but did not receive a stimulus payment. You could need IRS Notice 1444. That notice is going to be sent to anybody and everybody who did receive an advance or the stimulus payment. So if you didn't receive the proper amount of the stimulus payment, so let's say it was $1,200 per person, and let's say that there was a child that was in your household and you didn't get the payment included for that child, then you can claim the recovery rebate credit and account for it. Next big thing to know is that under the CARES Act, for all of my retirees, there are no minimum distributions for 2020 from an IRA or other employer-provided qualified retirement plan. Your next RMD is going to be in tax year 2021, which is the return that will be filed in 2022. In the case of anyone who had to pull money out of their 401k as it related to what was known as a coronavirus-related distribution, so part of the stimulus payments and the CARES Acts and all of the stuff that was being pushed out, the legislature, Congress, and the Senate said, hey, if you take a distribution out of your 401k between January 1st but before December 31st of 2020, you can use it because we realize that people are struggling. Distributions from the plan are includable in tax income, but you can include it and spread it over 3 years, okay? Beginning in the year of the distribution. The 10% early withdrawal penalty does not apply. So if you're younger than 59 and a half, you will not pay a penalty on it. But once again, you do have to include it in income. If you want, you can include the entire amount in the first year if you want, but you can spread it out, bringing your income down. Taxpayers may recontribute any portion. Basically, you can pay back the distribution anytime during the 3-year period, beginning the day after you take the distribution. I always love like IRS speak because it's always legal. So you can always tell the lawyers wrote it. And, you know, with the 3-year period beginning the day after the date on which the distribution was received and treated as a tax-free rollover. What does that mean? You can pay it back after you take it, the day after, okay? You decide you didn't want it, you can pay it back. And for businesses that took PPP loans, okay, if this is like a really big debate, like out there in the ethos, but not for us tax people. If you take a PPP loan and it's going to be forgiven, then IRS Notice 2020-32 states that you cannot deduct the expenses on your tax return if the income is or will be forgiven. Now people are saying, well, wait a minute. So I get a $50,000 PPP, but I can't write off the expenses on my tax return if the money's going to be forgiven. And the answer to that is yes. There is no double dip. You can't have income because if it's forgiven, you don't have to pick it up as income. So if your PPP loan is forgiven, you won't have to report it as income, but you can't double dip and then also claim the expenses. You know, it doesn't work that way. There's been, like I said, a lot of discussion about it, people kind of up in arms about it. But to be honest with you, this is really the way that income forgiveness has always worked. If you had a home, many people know if you lost your home to foreclosure, the banks would give you a 1099-C, cancellation of debt. And if you met certain exclusions, you didn't have to include it as income. But usually if you have like credit card debt canceled, you got to pick it up. So the IRS is saying, no, you can't get a debt forgiven and write off the expenses. I do have some clients that are saying that they won't request that their loans be forgiven so that they can write off the expenses. But that's a whole nother story. But the main thing to know is, hey, you might need to talk to your tax person if you took a PPP loan and you're planning on getting it forgiven. All right, enough said, because Jared can talk, and we got 45 minutes to do all this. Main thing for your health insurance. We all know that the repeal of the individual mandate meant that the taxpayers did not have to, there was no penalty for not having health insurance. But if you do obtain your health insurance through the state or federal marketplace, healthcare.gov, you may be receiving the advanced premium tax credit. If your income is too much, then you have to repay the credit. You still got to go through that whole rigmarole of reporting it on your tax return. So just know that that's still in play. 2 things that I did forget. I'm glad I got my notes down here. With regards to RMDs or minimum distributions, the age limit, the 70 and a half age limit for contributions to an IRA no longer applies. That has been removed, I believe, with the Secure Act. I don't think it was a CARES Act. And then the last thing for all my business owners who make estimated payments, do not forget that January 15th is the last day for you to make your estimated payment, okay? Federal and state. So, and that actually is a weekday, so it won't get moved around. All right. Moving right along. What are we going to talk about? So, we've got 2020 year-end tax moves, things that can hopefully save you money. And then we're going to talk about the Biden tax plan. Now, Jared, President-elect Biden is not the president yet. Why in the world will we be talking about the Biden tax plan? Especially considering that it's probably all theory at this point in time. True. But knowing what he had in his plan is going to indicate what the next administration may intend to do over, if not the next year, the next 2 years, because it's going to be pretty quick. And you may want to make moves based on that before the end of this year. So let's talk about ways that you're going to save, and I am going to go in depth on each one of these. However, it will be surface level. My retirees, we will talk about your RMDs. There's a new for 2020 as a result of the CARE Act, $300 charitable contribution deduction that people can take if they are not itemizing. They only take the standard. For those that have stocks, we will talk about stock loss harvesting and deferring gains until 2021. We will talk about some charitable giving strategies, how you need to watch out for capital gain distributions if you do have stocks. All my people out there, you know who you are, who have those mutual funds that give you that money. We'll talk about that. Itemized deduction bunching, that is a strategy. We'll talk about maximizing your retirement plan contributions. We'll talk about education credits and 529 contributions. We'll talk about shifting business expenses into and out of a certain year for my business owners, so stay tuned. And we will talk about deferring income until 2021. With regards to the Biden tax plan, we will talk about how things are being indicated to repeal certain Tax Cuts and Jobs Act components for high-income filers, how there may potentially be a new 12.4% Social Security payroll tax for, once again, high earners, the phase out of the qualified business income deduction, QBI deduction, expansion of credits for individuals and families, increasing of the corporate income tax rate to 28%, establishing a corporate minimum tax on book income, doubling the tax rate on global intangible low tax income. Really doesn't apply to most of you all who are even remotely watching this, but gotta throw it out there. And then tax credit to small businesses for adopting workplace retirement savings plans. Let's get further into it. RMDs, very high level. So under the Secure Act, RMDs from a qualified retirement plan and IRAs generally must be made by April 1st of the calendar year, following the calendar year in which the individual reaches age 72. So it used to be 70 and a half, it's now 72. And then effective for distributions required to be made, that is effective for distributions required to be made after December 31st of 2019, which means they are in play for this tax year. There are no RMDs needed for 2020. So if you are a retiree and you kind of were taking distributions out of your retirement plan because you had to, you might not have to. Now, you may get in the routine and say, Jared, I don't want to mess up my routine and my flow. Just realize, if you're a retiree that did pretty successful and you're taking out, 50, 60, $100,000 RMDs, you don't have to do it this year, which can help lower your income, because if there's no income there, lower your taxable income and lower your tax. So the next RMD won't be until tax year 2021. For those that are above the age and do need to take a RMD, theoretically, because once again, they're suspended, you would take any distributions by the required date, the end of the year for most individuals, and that there's a penalty for failing to do so. That's usually 50%. Okay, so just keep that in mind, and that applies to people who have 401ks, IRAs, 403bs, Roth contributions to a 401k, etc. Does not apply to Roth IRAs. All right, let's go on to, see, I hate when I do this. So what happened is like I gave you all that agenda, but then I didn't create a slide for this. So I'm just supposed to talk right now. This is the next slide. Anyway, so the special $300 charitable giving deduction. So this is new for 2020, and it's due to the CARES Act. You can't itemize. This is an above the line deduction. So what that means is people itemize, and sometimes people confuse this. People itemize when you are deducting medical expenses, charitable contributions, state and local taxes that you had out of your check, state property taxes, charitable contributions, mortgage interest. Those are the things that you itemize. And to the extent that those things exceed $12,400 as single, $24,800 married filing together or jointly, or $18,650 head of household, that means you are a single person, parent, has a child that you carry as a dependent on your tax return, until your deductions for those items exceed the standard, you just simply take the standard. The IRS gives you whichever one is greater, okay? So for this year, because those standard deductions are so high, most people don't itemize anymore. This is where sometimes, you would hear people say, oh, well, I don't donate to charity anymore because I can't itemize, I can't write it off. But what the CARES Act does is it gives you a $300 deduction if you don't itemize on the face of the tax return. This is the 2020 Form 1040, it will be out and ready for delivery and good in a moment. And you can see right here that I have highlighted in line 10B, charitable contributions if you take the standard deduction. This is what that's for. So the legislature kind of realized, we've got people who are hurting. We've got people who really needed a lot of help. Charities are going to need money. People sometimes make their tax or their giving decisions based off of what their tax write-off is going to be. So they just said, hey, guess what? In order to help everybody out, we'll give people $300 to incentivize them to do their donating. So the catch is that this is for everybody who doesn't itemize. If you itemize, we're going to talk about that in a moment, okay? But it's an above the line deduction, cannot itemize, $300, and it must be cash. So no donating goods, no Goodwill, Salvation Army clothing, any of that. It is literally just cash donations, okay? And like I said, it really helps charities this year. I got solicitations from, like the Greater Food Depository. I was like, okay, they said, hey, $25, $50, or whatever helps feed people that are really in need right now because, while some of us may be fortunate and we are still at work, we are deemed essential. So yeah, I'm actually. So, hey, we didn't miss a beat, but not all my clients are like that. Some clients are down about 1/3 in revenue, some even more. Gyms, some of my service providers that, face-to-face services can't do it or do it to the volume and the extent that they wanted to. So there's a need out there. This is the way that the legislature is allowing us to do that. Okay, let me get on moving. Number 3, stocks. Loss harvesting and deferring gains. So the short version of this is that if you have a stock loss, the IRS allows you to write it off, okay? But they also allow you to offset that against gains, okay? So if you have a bunch of stocks that have appreciated, that you were potentially going to sell and they're going to have gains, then loss harvesting is you look through your portfolio, or if you have an investment advisor, the investment advisor does it, or if you're in like a mutual fund or something like that, the portfolio managers will do it. But they look for stocks that have lost position and they can be sold. Or let's just say that you have, some loser stock from 2000 or something like that that's never coming back and you just want to offload it. If you have a bunch of stocks that have gains, you can then go ahead and use those losses to offset that gains, which then brings your taxable income down. Okay. So second bullet point, consider jettisoning your losing positions. And then after matching, short-term losses and short-term gains, then, it looks at long-term losses and long-term gains. But if you still wind up with an overall net loss, then you can use up to $3,000 of that loss to offset your ordinary income every year, and you can roll the rest over to future years. So the IRS will allow you to take the losses, but they only allow you to deduct $3,000 per year, but you never lose it. You can write those future losses off, as you roll down the road, okay? Deferring gains just simply means that, if you are forced to sell stocks, try to sell those with a loss position first. If you have investments that have held longer for a year, they're taxed at long-term capital gain rates versus short. So if you do have to sell your long-term positions versus your short-term. Short-term is taxed at ordinary income rates. Your long-term positions are taxed at a much lower rate, which ranges between 0 and 23.8%, depending on how much your income is. So in a year that you maybe have like $300,000 worth of income, you might be up in the 24%, rate. In a year where you only have $15,000 because maybe you were furloughed and you sold stocks, you might actually pay 0 capital gains. So timing is key. And if your income will be lower in 2021, then consider shifting those gains and selling those stocks next year and not this year. All right. What do we got next? We got charitable giving. So these are tactics for those of you who do itemize. So have a significant mortgage, pay a lot in state and local taxes or your state property taxes. Man, like Beverly, like the average property tax is probably about $7,000. There's some suburbs that are just like straight ridiculous with how much they charge. So if you have property taxes, mortgage interest, charitable contributions, you're usually probably going to end up being over the standard, and these are the strategies for you. So first thing, consider bunching your contributions. If you don't contribute enough to charities in one calendar year to make it worthwhile for you to itemize, then you consider making several contributions or several years worth of contributions all at once. So let's just say that hypothetically you were close, your itemized deductions were $22,000 married filing joint. You're within $1,000, $2,000 of being able to switch into itemized, but you were really going to do next year, this $50,000 contribution to this one charity because, maybe you're up in age and that's what you want to start disposing some of your money. Then consider doing it now. Okay, that's a bad example because you would itemize then too. But let's say maybe it was $10,000. then, you know, you move it into this year so that you can itemize and take the deduction in a year that you maybe, if you all you had next year was just $10,000 and nothing else, you would be taking the standard. Okay. So the other thing that you have to do is you have to consider, make sure that your contributions are made timely. Basically, if you're going to do a cash contribution, write the check, make sure that it gets cashed by December 31st. You know, or you write the check and it's in the mailbox by the December 31st. Personally, I try and make sure that it gets cashed and cleared. But given that it's December the 16th, you know, some people may have not figured out what they're going to do. Okay. But basically, you know, the same deduction timing before December 31st applies to anything you want to do with a credit card. If you charge it, you can pay the bill next year, but the charge will count in this year. Okay. If you do have stock, so this is a really high power strategy. This is one we usually charge a lot of money for, but you're a client, you get it for free. Donating appreciated stock to charities provides two tax benefits in one. The first thing is you avoid the capital gains tax. So like I said, if you're selling stock and you get rid of the stock, you have to pay capital gains tax on it. But if you donate it directly to the charity, so if you go into your brokerage account, Vanguard, Fidelity, whomever, and you say, oh, I want to move Amazon. Amazon went way up this year. You want to move a portion of your Amazon stock because you were just going to sell it. You can take your Amazon stock, you can donate it to whatever charity you want. And what happens is normally the spread. So if you bought it at 10,000, it was worth 50, you'd have to pay capital gains tax on $40,000. But what ends up happening is the donated stock goes to the charity and it counts as a $50,000 write-off on your tax return. And you don't pay the capital gains tax. Yes. So that's a high power strategy that we've used several different times with high income earners. The last one is transfer. You can transfer IRA money to a charity. So taxpayers who are age 70 and a half or older can actually transfer up to $100,000 from a traditional IRA tax-free to a charity each year, so long as they transfer the money directly to the charity. There have been some changes with this year with regards to rules, but the main thing is called a qualified charitable distribution. It has to happen direct. So what you would take as an RMD, theoretically, you have that moved over to the charity directly. You used to get a write-off for it. It doesn't work that way now. The QCD basically will reduce the size of your IRA because you're donating it, which means that any potential RMDs that you have to take in the future will be reduced because your RMD is based on your account balance. The key is that the check has to be cashed by December 31st. All right. This is another high power strategy for high net worth or high income earners using what is known as a donor advised fund. I didn't have this on the slide. But basically, you put your money or your other assets, such as stocks or personal property, into a donor-advised fund and allows you to deduct the entire contribution in the year that you make it. The donor-advised fund then, based off of your decision, decides when they actually will make the donation and to whom they'll make it for. But the key is that you get the deduction this year, okay? So as I mentioned, contributing one lump sum this year may help lift your deductions above the standard deduction and allow you to itemize. So it's an unlock type of strategy that we sometimes use. All right, doing good on time, kind of, sort of. The next thing is monitoring your capital gain distribution. So generally, when you have a mutual fund, you're required to pay out their shareholder gains realized on the sale of stock and bonds during the year. And if you own a fund that's in a taxable account, then you must pay the taxes on these distributions when you file your tax return, even if you reinvest them. So I have several clients that they get mutual funds, they have to sell out, or they give these distributions, they reinvest the distributions, but they have to report the distributions, and there's no tax held on those distributions. So then the taxpayer ends up paying money on them. Well, one of the things is, when you get hit with a distribution, you can review your portfolio to see if you have any mutual funds, stocks, or bonds that have declined. So once again, this is looking at stocks, saying, do I have any losers? Can I offset? If you are using a financial advisor or a portfolio manager, most of the time they're going to do this anyway, but you can just bring it up to them and just say, hey, can we look? I got distributions because they usually come out in November or December, some of which have already been made. Can you all look for anything that you can offset or that we can unload? Okay. So once again, just looking for loser stocks that you can potentially unload. All right. Here's another one that Jared didn't create a slide for. This was itemized deduction bunching. So this is very similar to what I was talking about with charitable contributions and bunching things and making sure that you pull things forward into the current year so that you get above the threshold. Basically, for itemized deduction bunching, you want to group expenses to get over the standard deduction. So charity, you can make sure that your mortgage payment is paid and cashed in December. That's going to be due January 1st. Any of those things that you can accelerate, you would do. So medical expenses, taxpayers can itemize medical expenses, but only to the extent they exceed 7.5% of their income. So if you're a retiree, they usually have low income. If you have medical expenses or procedures that granted, this is being done during COVID, so many hospitals are not allowing a lot of elective procedures, but anything that you can move forward, or maybe contacts or glasses, anything that you can move in. And then we already went over the COVID, the $300 charitable deduction. But the other thing to know for charity, your charity used to be limited to 60% of your adjusted gross income. So, for example, if you make $100,000, your charitable contribution couldn't exceed $60,000. You didn't lose it; it just got phased out and carried. Well, the CARES Act, I believe, actually removed that limitation. So now it's 100%. So you can contribute up to 100% of your income. So that is itemized deduction bunching. Once again, just moving things and shifting them forward. Retirement plan contributions. So all of my retirees, I got a piece for individuals and a piece for businesses. So the individuals, you can contribute up to $19,000 to an employer plan, like a 401k, 403b. And if you're over the age of 50, you can make a $6,000 catch-up contribution. So you can theoretically contribute up to $25,000 into your employer plan. What I tell people is if you're working, look at your pay stub, go look at your year-to-date column, see how much you've contributed into your 401k. If you are not at $19,000 and you're looking to make an extra contribution, do it. If you are over the age of 50, you can make the extra $6,000. Okay. The key thing to know is that pre-tax contributions will lower your take-home pay and they reduce your tax bill. Okay. If you're contributing to a traditional or Roth IRA for 2020, you have up until April 15, 2021 to make that contribution. You can possibly get a deduction for a traditional IRA contribution if you make below a certain dollar amount, and that is via what's the last bullet point, the Savers Credit. If your income, married filing jointly, is below $65,000, $48,700 as head of household, or $32,000 as single, and you make a contribution to a traditional IRA, and you're not covered by an employer-sponsored retirement plan, something at work, then you might be able to get a write-off. So for everybody out there, just make sure you mention this to all of your friends and your colleagues, especially, any of the younger folks that are making contributions. Just make sure that they are aware of this, okay? For all of my businesses, my self-employed individuals, so anybody who's files on the Schedule C, anybody who is an S Corp, this is for you, or multi-member LLCs also qualify. You can consider putting that side hustle money if you are Schedule C, like your Uber or Lyft or anything like that. Retirement contributions to either a SEP or a solo 401k plan. The amount that can be contributed to a SEP IRA or solo 401k is a maximum of $57,000 in 2020, but the contributions are limited to either the lesser of 25% of your salary. So if you're a wage earner, so like you have an S Corp, and you make $100,000, then you can only put $25,000 into a SEP. If you are self-employed, they look at the Schedule C and they say, okay, it's a net 20% of your business profit. So if your profit was $100,000, then you can move $20,000 into a SEP. The contributions count as a deduction to wage-paying businesses. So like S Corps, it reduces your taxable income on the business side. And if you get a K1, it's going to, reduce the income that you're going to pull over on the other side. And it's a win-win. I mean, retirement never hurts, all right? And it also counts as a deduction on Form 1040 if you're self-employed, Schedule C. All right. Education credits, I will be brief on this, but basically, you don't get a federal deduction for 529 plans, but, if you're paying for somebody to go to college, you can get a write-off either in the form of the American Opportunity Credit. So those are students that are within the first 4 years of education, and the Lifetime Learning Credit, which applies to undergraduate, graduate, and professional degree courses. So if you are taking a course out of college or some other institution, you don't necessarily have to be pursuing a degree for the Lifetime Learning Credit, but you can write those off. So make sure you get that. With regards to 529s, 529s are plans that you can stash money in for kids that are going to potentially go to college later on. So once again, they don't really reduce your tax bill, but it could lower your state tax liability. There are more than 30 states that allow you to deduct at least a portion of your 529 plan contributions on the state return. Here in Illinois, that is Bright Choice, Bright Directions, and Bright Start. In most states, you must contribute to your own state's plan to get the tax deduction, but several states do allow you to deduct contributions to any state's plan. The resource that I have on the screen for you is savingforcollege.com. You will see up here, we would just simply hit 529 plans, go to your state's 529 plan, and then we would just click on the lovely state of Illinois, since that's where we're at, but pick your state. And you can see that the Illinois 529 tax benefit, they allow you a deduction or an adjustment of $10,000 per year for single filers. And if you are married filing joint, you can contribute up to $20,000 to either a Bright Start, Bright Directions, or one of the other ones. College Illinois, I think, is also another one. And it reduces your state tax liability. So, hey, if you're thinking about, funding it, and you can actually fund a grandkid, niece, nephew, there's some technicalities about who owns the plan, but just know that it's a write-off for you. All right, expense acceleration. Basically, if you're an individual, you want to look for opportunities to accelerate the deductions to the current year. So once again, if you're itemizing, making payments for deductible expenses such as medical expenses, qualifying interest. If you own a business and people usually get medical treatments or medical services, could be a good idea to go ahead and send out some postcards and say, hey, come and schedule your appointment or whatever this year. Granted, yeah, there's insurance and who knows when you'll actually get paid, but they can deduct it on their end and then you look like a hero, okay? We usually get things from the eye doctor and things like that. Like, hey, you're going to lose your money in your flex spending account, spend those dollars. So, if you do offer medical procedures, chiropractic, dental, anything that is a qualified medical procedure that can be written off, encourage your people to come and get it. And on the opposite side, as a taxpayer, you want to advance medical expenses, state taxes, any of those things. If you're a business, what we say is spend, but don't just spend for the sake of spending. Move expenses into 2020 that you would have to pay in 2021. So anything that you would have to pay at the beginning of January, anything that you currently have on a monthly thing that you like and you would just move it to subscription, like Zoom, you can go ahead and just, sign up for your annual plan now and move that stuff over, all right? You can also consider paying your profits out as wages. So if you've had your books done and you can see that there's a profit left, you can pay them out as wages. The trick with this kind of sort of is if you're the only owner and your tax bracket is below the 21% corporate rate. This really applies to C Corps, not S Corps. But if you have staff and they did a good job, you want to thank them for sticking around this year and helping you out for COVID, then maybe give them a year in bonus. Those count as deductions. All right. The other thing that I had on that was for business owners, you can buy equipment and you can expense it. It's called a Section 179 deduction. So it allows you to basically, if I bought a bunch of computers and I can write them all off this year, anything that usually would have to be capitalized, x-ray machines, major equipment, lab type stuff. What else do we got? I got a safe around here. Just major things that would have to be capitalized and depreciated over time. You can take them as a 179 deduction. The limit on that is high. Yeah, for tax years beginning 2020, the expensing limit is $1,040,000 for the year. So it's available for qualified improvements as well as office build outs, as long as you're not the landlord and you're also the lessee, okay? Special tax rules around that, but interior improvements to a building's interior, can count. Nothing like a roof or HVAC, but some of those. And then, the property just has to be bought and placed in service before December 31st. So usually what happens is when you're going to depreciate property, you don't get the full amount unless you've taken it ratably over the year. This is, I buy a $5,000 copy or whatever. As long as I got the copier before December 31st, I can write it all off right now. So consider doing some of those things if you're a business. That's all I got on that. So where are we at? Last point for the individuals, defer your income until 2021. So basically consider looking for opportunities to move your income into 2021, especially if you think you'll be in a lower tax bracket then. For most, it's probably actually going to be the opposite. A lot of people were furloughed this year. A lot of people were collecting unemployment. A lot of people didn't work the full year according to how they normally would have. So their income is actually probably going to be lower this year than it may potentially be next year when hopefully, cross our fingers, we can all return to work and, do normal stuff. I host this webinar just because, but this is the way that we got to do things most of the time now. I won't pull out my mask, but anyway. All right. You might be able to defer year-end bonuses if you are an employee. You have to ask your employer. They may say, no, we want to take the expense now. Or you can delay the collection of business debts, business rents, or payments for services. So you could shift it to next year and lower your taxable income this year. For those who are freelance or independent contractors, you can consider holding off invoicing clients until December, like at the end of December, which they may actually delay your collections until next year. This only works for people who are cash basis, meaning like you record your income and your expenses in the year that you receive it in your bank account and you pay it out. It doesn't work for those that are accrual. If you're confused by that, don't worry about it. It's either on your tax return that tells you which basis you are, or your tax accountant knows. Okay. And doing so may delay paying the tax by 1 year, or it may at least put it, the income into a year in which your taxable income is lower. All right. So I said this thing was going to be 45 minutes, and I ended up talking a lot. I try and give you all a lot of good information, but sometimes it just doesn't, not that fast. All right. So the main thing to know about the Biden tax plan and why we're even talking about this is because I want to give you an executive summary on where things may potentially be going, okay? The executive summary of this is that under the Biden tax plan, there's anticipated there's going to be a rollback of the Trump administration Tax Cuts and Job Act tax cuts. Yeah, a lot to say, right? But the TCJA basically was funded with debt. So this is not a political, I'm not political, I'm the tax guy, I'm the money guy. So politics is outside of this. Keep that in mind when I say this. And if you're viewing this on YouTube later, this has nothing to do with politics. All right, so the Tax Cuts and Job Act was funded with debt, meaning that all of the tax cuts that were given by the Trump administration and the legislature at that point in time were funded on $1 trillion worth of debt over 10 years, okay? So it was kind of a setup in that if that administration didn't, okay, the administration is not going to last 10 years, but if that administration was out before another term, or at some point in time, taxes were going to have to be raised because it was funded with $1 trillion worth of debt. Wrap your head around that number. That means China's buying our bonds and they basically own us, okay? So that we can print money and do all these things. Well, that was before COVID. There were 2 stimulus payments. Oh, that was free money. Nope, not free money. Free money to you. It was funded. So the COVID funding for both stimulus, all the PPP, all that was funded with debt, almost to the tune of $2 trillion. The short thing is that, as you know with business and you know with yourself, you can only max out the credit card so much. At some point in time, China and everybody else around the world is going to be like, no, we're not buying U.S. debt anymore. You all need to pay us, okay? So it's a setup. The taxes are going to have to go up in order to wipe out this debt. So business taxes are going to go up. I say eventually. It's either going to happen part in 2021 or 21 and 22. The Biden tax plan includes attempts to help people through COVID and give relief to families. This is not finalized. This is just logical speculation at this point in time. The first anticipated impact as speculation would be maybe tax year 2021 for some things, because there's talk about extending, COVID-related benefits, not funding like the stimulus. So that would probably be the first round. And then it's probably really going to be 2022 for most other things, okay? I've been doing taxes since 1999, okay? So every administration puts their own stamp on the tax code. There were stimulus payments under George W. Bush. There were stimulus payments under President Obama. There were all type of credits that get rolled in. They roll in, they roll out. It really just depends. And within the first 2 years of every administration, those are usually when those changes are made. The Tax Cuts and Jobs Act, which was the Trump administration, impacted the 18 tax return 2 years after he took office. So the Biden tax plan, probably within 2 years of taking office. Let's move on. So the Biden tax plan, basically repealing a lot of the Tax Cut and Job Act components for high income earners. What does this mean? The Trump administration did give a tax cut by reducing the highest rate for taxes being 37%. So people who earned above $400,000 were getting taxed at 37%. Under the previous administration, the Obama administration, the highest rate was 39.6%. Under the Reagan administration, it was like 96%. It was something stupid. I'm being real serious, okay? So we think that they're probably going to move the rate back to 39.6%. Taxes on long-term capital gains. Once again, it's the tax rate on long-term capital gains is tied to your ordinary income. So the plan has talked about, long-term capital gains and qualified dividends at the ordinary income tax rate of 39.6% on income above $1 million, and it eliminates the step-up in basis for capital gains. Caps the tax benefit of itemized deductions to 28% of value for those earning more than $400,000, which basically means that taxpayers earning above that threshold pay a higher pay higher than 28% would face limited itemized deductions. There's to talk about potentially imposing a 12.4% Social Security payroll tax. So it imposes a 12.4%, basically SSDI, Social Security payroll tax on income earned above $400,000, $400,000 evenly split between the employers and the employees. But this is going to create a donut hole in the current Social Security payroll tax rate for wages between $137,000 and $400,000 because they're not going to be taxed. What else? So the phase out of the QBI deduction. So those who are Schedule C filers or those who have S corps, you currently get a 20% deduction on your tax return if you're below certain limits. There's talk about phasing out that Section 199A, the QBI, for filers who earn above $400,000. For the families, this is where trying to give relief for families, be more favorable to families, help people out with COVID. Expansion of credits. So the earned income credit for childless workers age 65 plus. Currently, you can't get the EIC if you're above a certain age. And it provides renewable energy related tax credits for individuals. Expands the child and dependent care tax credit from a maximum of $3,000, this is like daycare, and qualifying expenses, to $8,000, $16,000 for multiple dependents, and it increases the maximum reimbursement rate from 35 to 50%. So the takeaway with this in pure English, Jared, is that if you're paying for daycare, they're allowing you to deduct more of those write-offs for that. For 2021, as long as economic conditions require, this is AKA COVID, increase the child tax credit from a maximum of $2,000 to $3,000 for a child 17 and younger, and while providing a $600 bonus credit for children under the age of 6. Once again, this is all just speculation, but it's in the plan. I'll share the website with you that they used during the campaign. And then the CTC would also be made fully refundable, removing the $2,500 reimbursement threshold, and potentially reestablishing the first-time homebuyers credit, okay? It could give up to first-time homebuyers a credit of up to $15,000. So helping out the families. For the businesses, on the business side, if you are a C Corp, not an S, not a Schedule C, C Corp, you file Form 1120. We file Form 1120. We are Wilson Rogers and Company, Inc. It's going to take our rate from 21 up to 28. Boo for us. But hey, that's the way the cookie crumbles, people. We were a personal service corp, a PSC, and we were taxed at 39% at one point in time. So you win, you lose, all right? It establishes a corporate minimum tax. So if you got book tax of over $100 million, you might have to pay a minimum tax. Global intangible low income tax. This is for income that's earned by foreign subsidiaries of U.S. firms. So if you're a U.S. company, you have a foreign subsidiary, then you may potentially have something to do with that. The last of the Biden plan is workplace retirement credits. So looking to give tax credits to small businesses for offering or adopting workplace retirement savings plans. So offering 401k, 403b, there are various plans that are very specifically called workplace retirement savings plans. Those are potentially being discussed with regards to giving credits for the businesses, okay? So do you want to know where all this information came from? Would you like to see more of it? Then you can go to the Tax Foundation. This is a nonpartisan think tank. They always dissect all type of things tax. We use them to look at policy. So you can head over to taxfoundation.org/Joe-Biden-tax-plan-2020/#key. Just take a screenshot of the thing right now, just go take a look at it. I went over a little bit, and my contact information is on the top of the screen. All you clients, you all know how to find me. But for anybody who is not a client, we are a brick and mortar tax preparation, tax resolution, help you out of IRS debt, business services, bookkeeping, payroll, all those good things. And we do things remotely, been doing things remotely since 2005. I often joke, we only see 30% of our clientele face-to-face. And that's because they want to make sure we're real people. And outside of that, everybody else, we do taxes in 28 to 32 states, sight unseen, okay? We've been doing this remote thing for quite some time, all right? Just did a return for somebody out of California last week. Never met them, didn't Zoom, didn't do anything. Just handle it all over phone with regards to the communication. But we use secure client portals and all those good things to actually exchange data. So my information is on the screen. If you needed to email me or call me, you can do so at those. We are social. You can follow us on Twitter at Wilson_Rogers. You can find us on Facebook and Instagram, both using the same handle, Wilson Rogers Co. So Facebook.com, Instagram.com, Wilson Rogers Co. I already showed you our website, but if you go to wilsonrogers.net, you can hit our blog. We have over 182 articles on our website, including the one that I just did on the Money My Money Mondays one, that history stuff. Those are all there. Fun fact. So we are a tax preparation company. We have a website. Last year, 2019, we got 38,000 views on our website. And you're like, wow, 38,000 views. And that's kind of impressive for like people to talk about tax, okay? Tax is not sexy. It's not. So 38,000 views is crazy. This year, we just topped 80,000, right? Like crazy psycho. So that's the information. Our website has a plethora of it. So you are more than welcome to head over there. Someone indicated that, it was very helpful. I do these things because I do want to help our clients. I do want to provide you with the most valuable information so that you can make the most informed decisions and you can reduce and cut your tax bill. That how you can slash your taxes book up there, that was written with that in mind, okay? There's lots of people, lots of practitioners out there that will do lots of things to reduce tax bills, and maybe it's not in the most legal or ethical fashion, but what we do is we make sure that, because I do represent taxpayers before audits, and I see what they do to people. Some people actually are not scared of audits. Some people are terrified of them. But in working with the IRS, I know a lot of the bad things that can happen. I know what they look for, okay? And I don't want any of that to happen to you all. I want you all to be taken care of. So thank you very much. Happy holidays to everybody. If you are traveling, be safe. If you are not traveling, talk to your friends, your family, check on your parents, make sure everybody is okay, check on your loved ones. People got it rough out there, okay? So just lend a helping hand to your fellow human and your fellow neighbor. I'm gonna say it's much appreciated. And until the next time, or like I always say on those Monday Monday videos, it's been fun, it's been real. And until we meet again, let's all continue to mind my money, and I will see you all next time. Thanks for joining. Have a good one, guys.